This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Spring cleaning, how you can spruce up your investments even as the markets seem frozen.
Free trade, fair trade. Political leaders drop a pledge against protectionism while business executives express some concern.
And taking off, why you may have to pack a little extra patience when traveling this spring. Those stories and more tonight on Nightly Business Report for Monday, March 20th.
Good evening, everyone, and welcome. Well, a new season is here, a new beginning, but there were few signs of spring on Wall Street today. Stocks barely budged, continuing a trend over the past week or so. Comments from Federal Reserve officials and developments from the weekend's meeting of the Group of 20 industrialized nations in Europe were not enough to move the market decisively in either direction today. The Dow Jones Industrial Average fell 8 points to 20,905. The NASDAQ was up a half point. Meanwhile, the S&P 500 fell 4.
Despite the frozen markets, it's finally spring, and it is also the time of year when many investors look for ways to get their financial house in order. Our guest has some ideas that could help you with your investment portfolios. She is Lizetta Braxton, founder and CEO of Financial Fountains. Nice to see you again, Lizetta. Welcome back.
Thank you, Sue. Good to be back.
So spring, obviously, you think about spring cleaning. So it's kind of like opening up that laundry room door and saying, you know what, I have to rearrange the closet. You're rearranging your portfolio.
Absolutely. It's a good time to think about what you did last year. And I say that because it's tax time. And when you wrap up your taxes from 2016, you have a great idea of what you did well or not so well. So it's right in front of you to plan for 2017 now.
Let me ask you about 401ks and other similar defined contribution plans that a lot of people have. A lot of people have multiple employers. They may have multiple past plans where they still have open accounts. Is this a good time of year to take all of those stray 401ks to which you're no longer contributing and roll them over into one consolidated account?
Absolutely, yes, for several reasons. One, your previous employer, you don't know how long they're going to be around. You're not in touch to what's going on. So bring over your 401k to your current employer. But before you do that, also make sure that you understand your existing 401k and the fees that you're paying as well, too. So consolidating your assets just makes it very easy to know where your money is, how it's being managed, and having multiple accounts sometimes just seems overwhelming for people.
You know, you also make the point that it's a good time to rebalance your retirement account, perhaps this year more than most, because we've had such a huge run-up in this market since right after the election and the first of the year. Do you take some money off the table and reallocate it? How would you go about looking at your portfolio and deciding how to rebalance?
So first, yes, the run-up has been going on for quite some time, so not just because of the recent election. Given that the run-up has been at least 8-9 years now, yes, take some of those gains and reinvest them, particularly for those who are approaching retirement, looking to turn some of that capital gains into income. So shaving, some of the capital gains will be something to consider as you rebalance your portfolio.
So quick answer here. As I rebalance, if I want to sell stock or equity holdings, should I look that have a profit in them? Should I look first at doing so in a tax-sheltered account where I won't be creating any taxable event?
You're absolutely right. So it's good to know retirement accounts, tax-sheltered, no capital gains. Absolutely. And that's a part of the great thing of rebalancing and deferring those taxes.
All right. Thank you so much, Lizetta. Nice to have you with us. Lizetta Braxton with Financial Fountains.
Well, a lack of inflation was the reason why the head of the Minneapolis Fed was the lone vote against an interest rate hike at the central bank's meeting last week. In an interview today, Neil Kashkari said inflation is still below the central bank's 2% target.
If we're coming short on inflation and the job market shows more signs of slack, my question is, why do anything? Why not allow this to continue until we see that we're actually reaching maximum employment?
Mr. Kashkari said inflation can rise above 2% without creating worries about an overheated economy.
Another relatively new voting member of the Federal Reserve also said he's okay with inflation running a little bit above that 2% level. But as Steve Leisman reports, it's otherwise hard to pinpoint where exactly the head of the Philadelphia Fed stands.
It's been an 18-month Fed mystery. When Philadelphia Fed President Patrick Harker took over from Charles Plosser in mid-2015, the question was whether he would continue in his predecessor's hawkish path. Today, in his first CNBC interview, Harker revealed he's not going to be so easily pigeonholed. The former University of Delaware president, who is voting for the first time this year, said he supports 2 more rate hikes, but isn't in a hurry to do more than that.
Coming into this year, I thought that 3 rate increases made sense. I'd like to pace those out. That is, I don't want to get behind the curve, but we're not in any rush either. So I think we have time to increase over the course of this year.
If Donald Trump passes a broad range of pro-growth stimulus, Harker says more rate hikes are possible. But he's also in no hurry to react to the effects of policies that haven't been passed yet.
If we have corporate tax reform, which makes sense to me, but we also raise trade barriers that might hurt some industries here in the U.S., what's the net effect of that? Well, the devil's in the details, right? Until we see the details of what that all means, it's hard to factor it into a forecast.
Finally, if Harker were a hardcore hawk, he'd see the 2% inflation rate as a ceiling and wouldn't want to go any higher. But Harker says he's okay if the inflation rate goes over that level for a while.
So I think we're there and we're moving in the right direction. There will be a little bit of an overshoot, and that's okay, and that's appropriate.
Harker may yet end up following his predecessor's course, but for the moment he looks set on a route firmly in the middle of the typical hawk-dove flight path. For Nightly Business Report, I'm Steve Leisman in Philadelphia.
United Kingdom will start the process of leaving the European Union next week. Prime Minister Theresa May will invoke Article 50, the mechanism for leaving the bloc. It's never been used before. It will launch 2 years of complex negotiations to untangle Britain from European economic integration.
Trade tensions pressured stocks across the globe following the weekend's G20 meeting. Finance ministers from the world's largest economies dropped a pledge against protectionism, a move pushed by Treasury Secretary Mnuchin. And globalization was the topic of conversation at a meeting of business executives in China. Eunice Yoon in Beijing has that part of the story.
While G20 policymakers dropped a pledge to freer trade over the weekend in Germany, here in China, at one of the most exclusive conferences, elite business leaders and government officials reiterated their hopes to promote globalization. Many of them expressed disappointment in the talks at Baden-Baden.
It's pretty disappointing when you get finance ministers for the leading countries of the world who, out of the blue, are unable to validate the commitment to anti-protectionism, which is the underpinning of globalization.
Germany has supported the negotiations on free trade agreements, be it in Asia, the TPP, or the TTIP with the Western world. And we see that it's getting difficult to realize these free trade agreements.
President Trump's America First agenda has raised concerns about possible trade wars, though the CEO of Dow Chemical and a member of President Trump's Manufacturing Council tried to allay some of those concerns.
This is not a zero-sum game. We all know that. People who trade in the global system, we know what has to happen here. And to satisfy population's feeling of inequity, globalization hasn't been fair.
Even so, people here have been telling us that a meeting between President Trump and China's President Xi Jinping in Mar-a-Lago could result in a better relationship.
The most important objective is to build chemistry, is to meet the person, right, and to shake hands, to touch the person, to know what the person is really about, rather than going through the various kinds of channels like tweet, like internet, like traditional media.
For Nightly Business Report, I'm Eunice Yoon in Beijing.
Still ahead, what the rolling back of some housing rules could mean for both buyers and sellers. Customers are not opening new accounts at Wells Fargo. Checking and credit card openings fell more than 40% in February from a year earlier, extending a trend that started after the bank's fake accounts scandal last summer. But there was some good news. Wells Fargo saw an increase in average consumer and small business deposit balances.
CEO pay is at a record. According to the Wall Street Journal, median pay for chief executives at some of the biggest U.S. companies rose nearly 7% last year to $11.5 million. That's more than offset the pay cut that they took the previous year. The increase is attributed to the rising stock market, along with higher dividends and buybacks, because stock awards are becoming a bigger part of total compensation.
As we've been reporting, the deregulation and prospect of deregulation has been a powerful force in the stock market. And tonight we look at what it could mean in the housing industry. Lenders and builders are excited about its potential. And as Diana Olick reports, rule changes could also have a big impact on buyers, sellers, and the health of housing overall.
If you're shopping for a home this weekend, you probably already know the pickings are slim. There are very few existing homes for sale, and the home builders aren't adding enough. Why not? They blame, in part, regulation.
There's just too much government interference, too much regulation, which drives up the cost of housing and lowers the builders' profit margins.
Local, state, and federal regulation compliance costs now make up about 25% of the cost of a new home, according to the National Association of Home Builders. That's up over 30% in just the last 6 years. Builders are looking to President Trump to lower their costs.
Some of the regulations that were enacted in the last administration are at least starting to be talked about being rolled back. There was a couple have actually happened, but I think that is going to be a big positive impact for our industry, and we're pretty excited about it.
So excited, in fact, that a monthly reading of home builder sentiment in March jumped to the highest level in 12 years, even though builders are still selling historically few homes. That divide between sentiment and sales is wider than ever. And that confidence could come right back down. Home builders are still facing a severe shortage of land and labor, and mortgage rates are rising. But lenders say that's another area where deregulation could help.
As an industry, we're hopeful that softening of regulations will promote liquidity coming back into the mortgage market. That would be good not only for the industry as a list volume, but it's going to provide greater credit availability to consumers.
Mortgage rates are still historically low, down considerably in the past decade. The difference today, though, is that most of the mortgage market is government-backed, with very strict credit requirements to get the loan at all. Deregulation could change that.
So I think you really look for opportunities where Fannie and Freddie, FHA and VA just do not serve the consumer, and then you come up with new programs that ultimately will satisfy that customer experience, because not everybody fits into that box.
Which is why so many today still can't buy a house. For Nightly Business Report, I'm Diana Olick in Washington.
Caterpillar sees retail sales improve, and that's where we begin tonight's market focus. The industrial equipment maker said machine sales fell during the latest 3-month period, but still the decline was the smallest in more than 4 years. And as for construction sales, they were positive for the first time in almost 3 years. So shares rose more than 2.5% to 95.40. The drug maker Aspirion said the Food and Drug Administration thinks the company's cholesterol treatment could be approved based off of results from an ongoing study. The company said it plans to submit a new drug application in 2019. Shares took off. They soared 74% to $41.22 on the trading session. International drilling contractor Borr said that it signed a letter of intent with rival Transocean to acquire 15 of its oil rigs for more than $1 billion. The deal includes 10 of Transocean's current rigs and 5 that are under construction. Transocean shares fell 2% to $12.22.
Dominion Diamond said it has turned down a more than $1 billion unsolicited takeover offer it received in February from private conglomerate Washington companies. The Canadian miner said the proposal didn't recognize the full value of the company, but that it was prepared to engage in further discussions. Washington Companies owns a group of mining and industrial businesses. Dominion Diamond shares, I should say, popped nearly 23% to $12.20. Watchmaker Movado posted a drop in quarterly sales and profit while forecasting a challenging year ahead. The company also said it would cut its workforce, mainly affecting operations in North America and Switzerland. Movado said that move, along with other cost-saving initiatives, will help improve profitability. Shares rose almost 6% to $25. And the organic chain Sprouts Farmers Market has reportedly been involved in preliminary talks with supermarket operator Albertsons regarding a potential merger that would take Sprouts private. Albertsons is owned by the private equity firm Cerberus Capital Management. Shares of Sprouts fell a fraction to $21.83.
A key executive is leaving Uber after just 6 months on the job. Jeff Jones, who was president of the fast-growing ride-hailing company, told tech news site Recode that his approach to leadership is inconsistent with what he saw at Uber. And this is just the latest in a string of other recent controversies for the company. In January, Uber was the subject of a consumer boycott, which saw an estimated 200,000 users delete the Uber app. A former employee published allegations of sexual harassment at the company, and Google's self-driving arm Waymo filed a lawsuit against Uber, alleging its technology was modeled off of stolen intellectual property. CEO Travis Kalanick was also recorded having an argument with an Uber driver. And a New York Times report said Uber used a secret tool to avoid regulators.
So if you run a fast-growing private company facing controversies like Uber, is it better to remain private or go public? Eric Gordon is a professor at the University of Michigan's Ross School of Business. Professor Gordon, welcome, and congratulations on the Wolverines' run through the tournament so far.
But go blue.
Go blue. I knew I'd get you there. Let's talk a little. I know why companies go public. It enables the founders and the investors to cash out. But beyond that, I really don't see why anybody would do it. You've got to deal with Wall Street and pesky shareholders.
Yeah, you know, and a lot of company founders are starting to agree with you. We're seeing fewer and fewer IPOs, kind of ironically because the law changed and made them easier. Nevertheless, you know, the hassle of dealing with activist shareholders, equity analysts, and the ongoing expense has made a lot of them say, you know, maybe we'll do it never, or more realistically, we won't do it until we have to.
So what about staying private then? What are the advantages and the disadvantages of keeping your company off of the public market?
Well, you never have to worry about an activist showing up. You don't have to do this kind of dog and pony show every quarter where you try to convince people that every quarter is good, every quarter is going to be better than the last quarter. You can plan for the long term. You can do some stuff that equity analysts would think is crazy. Things that people like Jeff Bezos at Amazon have been able to do, even though it is public. He has kind of a setup that lets him act as if he's private. You can build the long-term value of your company, and you have a lot more privacy. You know, when you go public, your next door neighbor can look up your salary, and not everybody's interested in that.
Let's talk a little bit about the capital side of the business. If you own a private company, and let's say you can't raise capital any other way to expand, to build a factory, or maybe do an acquisition, I can see there that the issuance of shares could be very helpful.
So that's what pushes you to go public, even if you don't want to. It has something to do with capital. Either you need new capital to grow because you've outgrown your present sources of capital, or you want to acquire a big company and you don't want to use all cash, or the people who put capital in want their capital back. People like venture capital funds don't stay with you forever. They actually need the cash back, so sometimes they're pushing you to take them out. So it's, you know, sometimes you're getting pushed and you're doing it even though this is not what you want to do. It's like your friends pushing you into the swimming pool.
Whoa, that doesn't sound good. And I would assume that venture capitalists basically have a set amount of time before they expect their money back. That's pressure on a privately held company, is it not?
Yeah, so that's exactly right. I mean, most venture capital funds only last 10 years. If they invested in you in their third year, after 7 years, they want their money back, and usually a lot earlier because they're doing another fund. So you get kind of a conflict of interest. What the venture capitalists want and what the founder wants can be very different.
Professor Gordon, thank you very much. Eric Gordon is with the University of Michigan's Ross School of Business. See you soon. Well, some sad news tonight on the passing of a Wall Street legend. David Rockefeller was the last living grandson of the oil tycoon John D. Rockefeller. His father, John D. Jr., built New York City's Rockefeller Center during the Depression. During a long career that blended philanthropy, diplomacy, and finance, David Rockefeller was for many years the chairman and CEO of Chase Manhattan Bank. He reportedly gave away nearly $2 billion in his lifetime. David Rockefeller was 101.
Are you planning on a getaway this spring? A new report shows a record number of people will be flying. In fact, Airlines for America estimates 145 million travelers are expected to take a flight in March or in April. Phil LeBeau has more on why so many are taking off and what they should expect when they board that flight.
If you're traveling this spring, pack a little extra patience. There will be more people than ever flying, nearly 90,000 more every day. That means crowded planes and airports. This continues a trend that has pushed the number of people flying on U.S. airlines to an all-time high, topping 800 million last year. Why are so many taking to the skies? Well, consumer confidence is close to a record high, so people are more comfortable taking a trip, especially with the economy gaining strength while unemployment remains low. And right now, airfares remain relatively cheap. But the website Hopper.com, which tracks airfares, says domestic tickets will rise between now and June, when the average ticket will go for $256. That's a slight increase compared to last year. Airlines have been adding planes and flights to prepare for the growing number of people flying this spring. In addition to carrying more passengers, the airlines are looking forward to the spring because many are expected to show positive growth when it comes to passenger revenue per available seat mile. That, along with the expectation of fewer regulations under the Trump administration, explain why airline stocks have been outperforming the rest of the market for most of the last year. Phil LeBeau, Nightly Business Report, Chicago.
And finally tonight, there are more than 2,000 billionaires on the planet for the first time ever. According to Forbes, Bill Gates is the world's richest person for the fourth year in a row. Fortune, $86 billion. Gates' buddy Warren Buffett, second spot. And moving into the third spot for the first time, Amazon's Jeff Bezos.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.